Kindly note that the views and opinions shared in this video are those of the speaker and do not constitute advice given by Classic Private Wealth. Any advice given by Classic Private Wealth will be in writing in the form of a wealth management proposal. Classic Private Wealth is an authorized financial services provider.
Part of what I want to kick off with is what is new. What has happened in the last week or two that we didn't foresee, or that where we are validating opinions that we may have had. What's new in the world? And the first thing that's new is we've seen something completely unprecedented. We've seen oil trading at negative prices. So if some of you have attended talks previously will know that what I've said is that in this circumstance, it's a little bit like Alice in Wonderland. You go into the rabbit hole and everything is upside down. So you are now paying people to just take the oil away from your oil production site. You're not charging them money for the oil. So that's an upside down thing if I've ever seen one. It's happened on very specific contracts in a very specific place, so we shouldn't get too general about it. But in essence, what we've seen is that when we talked about 2 weeks ago, we were in a situation where Donald Trump had just announced that he has brokered a deal between the US and the Saudis and the Russians, and that they are going to support oil prices. And the oil price actually went up from about $20 per barrel to about $27 per barrel on that announcement. It turns out that that announcement is only taking about 10 million barrels per day out of production, and the COVID crisis is taking about 30 million barrels per day out of consumption. So it's way too little, and oil prices started falling again. And we're now back at roughly a $15 price for oil, with oil still falling, because actually what has happened is that oil producers have not reacted fast enough to cut oil production, and therefore oil is spilling out everywhere, and oil storage capacity worldwide is now roughly full. So we're seeing a massive impact of this in the oil market. So the one market that we think is realistic is the oil market, because they actually have to deal with the physical stuff. And so that's the one part of what we've seen. The second thing that's new is that all the talk around the world is no longer about how do we bring the virus under control in the first place. In most places where the virus has turned into an epidemic, that those epidemics seems to be coming under control gradually. So in a place like New York, they are seeing fewer infections. So they're saying we can see the end of this, but we will still stay locked down until roughly the middle of May. And then we will gradually start to reopen our economies, because we are also feeling a lot of pain in terms of the economy. So there's talk about how do you open the economy, because the other thing that is happening is a lot of the pain associated with the lockdowns are starting to present around the world, and also in South Africa. So I'm going to talk about the world and world markets first, and then I'll actually come back and make some comments about what's happening in South Africa. Right. We've got Mervyn saying that he's not coming onto the meeting. I'm not sure why. Anyway, let's...
Tamron, will you invite him again?
I'll do that now.
Okay, thanks, Tam. So if we just look at what's happening around the world, it is now becoming clear in terms of the statistics that we're getting that we have a significant problem in the economy. So the depth of the recession is starting to become clear. The first thing we're seeing is some first quarter figures coming out. Now, in the first quarter, most places in the world, we only have had roughly 1 month out of 3 in lockdown. So we're seeing roughly 10% drawdowns in most cases, most economic reports around the world. So it looks like the 30% drawdown in the economy is roughly right. The other thing that we're starting to see is we're starting to see various companies going into various levels of bankruptcy. So we've seen Virgin Australia go into debt rescue. So airlines are taking severe strain, obviously. And those airlines not owned by governments are basically getting close to bankruptcy. Obviously, some of them will be more vulnerable than others, depending on how strong the balance sheets were before. But airlines have basically lost 90% of their income, and they still have quite a large portion of their expenses. So airlines are going bust all over the place. And we're also seeing that rescue money that has gone out is being taken up at unprecedented rates. So there was a roughly $350 billion budgeted in America for small business aid. That money is already run out. So they've had another package of $487 billion approved yesterday. So what we're seeing is that the extent of the economic harm is becoming clear around the world. But also there's lots of discussion about how can we open up and how do we open up intelligently? What level of restrictions do we have to have at the back end of bringing the initial epidemic under control? And what's happened is that in general, up to about 2 days ago, when the oil crisis, this oil crisis not being oil crisis of prices too high, but oil crisis of prices too low. Before the oil crisis, we saw markets coming back close to 20% from the bottom. So markets went down initially by about 35% when the extent of the crisis started to become clear. It went up about 18%, not quite 20%, and now down another about 5%. So net, markets are down just more than 20% worldwide from the top. And we believe that that is still way too little. So let me maybe give you an idea of how I think that the market scenario plays out. What we're seeing at the moment, we're also seeing it in the sectors that are being affected. What we're seeing at the moment is the basic idea, and this is also propagated by Donald Trump because he wants to get re-elected, that this is an incident that passes quickly. So basically the virus will come and the virus will go. And then after the virus, we go straight back to the economy that we had before the virus came along. So a little bit like a natural disaster. But even natural disasters, if you talk about Katrina, I was reading up the other day on the virus's impact on New Orleans. What we're seeing in New Orleans is that they say, well, the community is still struggling after Hurricane Katrina. So actually the damage of a disaster can be very long lasting. And so there seems to be the opinion in the markets that this is something that is short-lived and where we go right back to where we were before. So the kind of companies that struggle during recessions are not being marked down. It's only the companies that are struggling to operate in the lockdown circumstances that are being marked down. There's no preparation yet for a deep general recession. So from a market's point of view, what I would say is I'm absolutely convinced that we are seeing something that will be much more widespread and that will impact many other sectors. So if you're thinking about what's happening in the oil sector in the US, the oil sector employs roughly 10 million people in the US. So about 5% of all workers employed somehow in the oil sector. Now, of those people, we're probably going to see about half lose their jobs permanently. Because the one thing that we are seeing at this moment, if we're talking about what's happening in oil, there's much more permanent damage in oil than just the cycle of coronavirus that will pass. We won't go back to the oil market that we had before. So effectively, our view differs from the general view in markets. And our view is that we will come out in a very deep recession. And that recession will take years to dissipate, meaning we'll see a recovery that is maybe similar to what the recovery was after the credit crisis, where basically GDP only got back to its previous 2007 levels around 2013. So it took 4 or 5 years to get back to the previous levels of employment and economic production. So we think we lose somewhere between 10 and 30% for a while, but that we actually don't go back immediately to the previous levels of production or of employment. So we think that a lot of people will stay unemployed for a lot longer, and that there will be a much bigger restructuring of the economy. So what does that mean from an opportunity point of view and from a market's point of view? So the strategy that we are proposing is that we think that this is the right time to hold cash. There are some things that are happening in markets that may start to present opportunities, but essentially, we don't think the opportunity to invest comes before we see the bottom of the recession and before the fact that we will come out of the crisis with a general deep recession that has to be addressed afterwards. Before that is widely recognized, we don't think the buying opportunity comes along. So what we're doing for our clients is to say, well, we are pretty much in cash right now. We think that markets should roughly halve. So we will start buying again into equity markets, roughly at the point where markets are down 60% from the top. If you think about that, that means around a 20,000 level for the South African Stock Exchange. Markets, we believe, are still way overvalued and not reflecting this crisis. But we do think that the crisis will present a unique opportunity, something that comes along maybe once in 10 years. So 10 years ago, we also had an opportunity to buy into markets at a level that was 40% of the pre-crisis level. And then we had a multi-year bull market, meaning we had roughly 5 years of consecutive gains in stock markets worldwide with actually little risk attached to being invested in stock markets. So we think that the period from 2021 to 2026 is basically a replication of the period 2009 to 2014. So we think there will come a great opportunity to be invested in world stock markets. But what you will need to do is you need to have cash to be able to utilize that opportunity. So what we're saying to our clients is use the fact that markets have not adjusted completely to get into cash and then stay in cash patiently. We are not going to try to participate in the rallies during the bear market. So what typically happens is that when you've got a true bear market, meaning a long-lasting bear market, you get upswings and downswings, but the downswings are always larger than the upswings. But it means that you can have more than one incident of 10 to 20% rise in the market in the general downward trend. So we can't identify those small ups and downs accurately enough to partake in those small ups and downs. What we do want to do is to wait until we know that we are close to the bottom and to then buy into the market. And then there will still be, in the initial stages of a bull market, there's quite a lot of volatility. There will still be significant volatility left once we go back into markets. But if we then patiently wait for the economic recovery to happen, which it will eventually do, we will actually get to a point where we think that our clients will participate greatly. One of the things that we hope to participate in is we also think that the oil price goes back from somewhere between $10 and $15 at the bottom it eventually goes back to about $35 an ounce. So this may be a bit of a surprising number for many people listening, because the general opinion is that there will be a diminution in the capacity to produce oil, especially in fracking, and that once we get back to normality, there will be a shortage of oil, and therefore the oil price might go back to $60 or $70 a barrel. We don't believe that's true. We think that the Saudis want to permanently take the fracking industry out. So the Saudis will pump a lot more oil to keep the oil market balanced at about $30 to $35 an ounce, which is too low for fracking to come back. So we think that basically the fracking industry in the US is going to be dead. And therefore those job losses in the fracking industry will be permanent job losses. Those people will have to be employed elsewhere in the US economy, and that the US will actually go back to being an oil importer at the end of this. Maybe just a side comment for those people interested in politics. When this crisis started, there was a meeting between the Russians and the Saudis, and the Saudis then said, but the Russians are not cooperating. We want to teach them a lesson, and therefore we're going to open the taps and pump a lot more oil. That's what they said in public. What they actually want to do is they want to take the fracking industry in America out. Those are the most vulnerable producers of oil. So a lower oil price will take the fracking industry out, not the Russians. But if you are the crown prince in Saudi Arabia, you can't tell your friend Donald Trump, who's supplying you with weapons and aid, that you want to take one of the biggest industries in the United States out. So ostensibly your target are the Russian producers, but really your target is the American producers. So we don't think that the price of oil goes back to anywhere close to what it was before, and we think there's a permanent reduction in the oil price, and that will become part of a longer-term trend as green energy replaces oil in the world economy. So that's a different structural thing. It's not really to do specifically with the virus. The other thing I want to address is the whole question of exchange rates, because one of the byproducts of this whole crisis has been that emerging market currencies have come under great pressure. So whether it's the Turkish lira or the Brazilian real or the South African rand, all of these currencies have gone down somewhere between 10 and 20%. And the question becomes, is that a fundamentally justified move in currencies, or is that just a liquidity effect? And in essence, our basic view is that this crisis affects the whole world in roughly the same way. It will be handled differently in emerging markets than in developed markets, but it doesn't permanently put emerging markets in a worse position than developed markets. And therefore, there's no permanent reason to think that exchange rates should be lower in emerging markets. Exchange rate should be roughly where they were before the crisis hit. So for South Africa, that means somewhere between 14 and 15 to the dollar, rather than the somewhere around 18 to 19 to the dollar that we're seeing currently. So we think that the rand, once we see calm return to markets, will return to somewhere around the 15 to 16 level, most likely, just because of obviously the demand for commodities, which is what we mostly export, will be a lot lower than it was before, but also our own demand for imports will be a lot lower than before. So it's difficult to tell exactly where that balance lands. But in our view, the rest of the where once we get to recovery, there will be massive spending on infrastructure worldwide, and that is very commodity intensive. So we actually think that in the early 20s we go back to what was in the early noughties, meaning we go back to some kind of global super cycle in commodities, where for multiple years commodity prices will just stay high because everybody around the world will just be actually doing more and more infrastructure stuff. So effectively, we think that 13 or 14 to the dollar in 2 or 3 years' time is very much on the cards for the rand. So we're not actually as concerned about the currency as we are about shares. I have a question about shorting the market. Basically, from our point of view, shorting is always a bit of a risky strategy, because if you go long of any investment, that's a risky investment. You have the so-called risk premium on your side, meaning there's a trend line of 6% per year upwards that actually is to your benefit over time. So we're in general just much more hesitant to short something, but we do think that markets are way too high, and there's a very, very high likelihood that markets will come down. But rather than shorting the market, we would rather wait for the bottom of the market and go long of the market at that point, and then stay invested in the markets at that point. But if you were a hedge fund manager, I guess you could, there's an opportunity to say there's a short in the market. One of the other opportunities we think that comes along is there's a difference in the price between West Texas Intermediate oil and Brent crude. Now, this has got, the fact is that in America, they're producing too much oil, even for local consumption, but they don't have the infrastructure to export, because they've never really been a large exporter of oil in the last 3 decades. So the oil is really just remaining there, and that's pushing a significant gap between West Texas Intermediate and Brent crude. Brent crude meaning oil produced elsewhere in the world where there is the facility to move it around. And we think that in the end, those two things will go back as the frackers stop investing into new fracking capacity. Fracking oil will gradually reduce over the next 2 years to very low levels, which would mean that the Americans would have to become importers of oil again, and that the oil stockpiles in America will be used up. And then West Texas Intermediate and Brent will go back to roughly the same price. So if you're a hedge fund manager, you may be able to use that discrepancy to your advantage. So in essence, what we're saying is we think that this is an economic disaster. We think that stock market prices are not reflecting the economic disaster. So we think the biggest opportunity for close on a generation is to wait for the full impact of this to be apparent in markets, which will push markets a lot lower, then enter the markets and wait for the multi-year recovery. So nothing like a V recovery, something much more akin to multiple W's put next to each other, if you like, in terms of market and economic recovery. Not quite an L shape, as some commentators have it, but certainly not a V-shaped recovery. We've used up our half an hour. I think that my views are pretty clear, but maybe questions and comments.
Wikus, Jaco,
Hello, Jaco.
I've got your statement that the markets are definitely not reflecting the state of the economy.
Yeah.
It is, some commentators describe it as the markets are defying gravity. But there are two schools. Some schools say, yes, the markets are defying gravity and they should go lower, as you said, and other schools not. So it's very unclear for us as investors who's going to win this intellectual battle. You know, you part of the bears that say the markets will still go, I think you said half of what it is now.
Yep.
There are many analysts that totally disagree with that. I mean, how do one now try and get some truth out of this?
So the first thing that you would say is I'm actually, in normal circumstances, a believer in efficient markets. So I'm very hesitant to say that markets are wrong ever, because markets reflect the collective wisdom of very clever people managing billions of dollars. trillions of dollars. So in fact, I'm very reluctant to go against markets. But what my experience is that markets are actually quite good at adjusting to things that happen for a second or a third time. So they typically get it right the second or the third time, but not the first time. And what happens mostly in markets is that markets are the collective decisions of the current participants. So what I would say to you is roughly at least half of all asset managers around the world has never experienced a bear market personally. So they've entered this market after 2009 and they've been buying the dips, and that has been the correct strategy. Those people who have not bought the dips over the 10 years have been fired all around the world, or their clients have left them. So I think that the participants are way too bullish. So they are inclined to believe the bullish side of things. So what I'm taking some comfort from is I follow the world's best economists. So people like Paul Krugman and Larry Summers, who are recognized as some of the top economists in the world. And Larry was on Sunday on Bloomberg. And what he was saying is all the news I've heard in the last 3 weeks are bad news for the economy. So he's actually become more and more bearish about what happens in the economy. So basically, serious economists don't actually have a lot of difference of opinion about what will happen in the economy. They all think that we will go into a serious recession. And effectively, markets are saying that we will not have a serious recession. We'll have an interruption, but not a serious recession. So I've got two questions here in front of me as well from Jonathan Zuckerman. So Jaco, maybe just to finish with your question, my own view is that we haven't had a serious recession in the last 30 years that wasn't accompanied by at least a 40% drawdown in markets. So a 20% drawdown is not close to enough to reflect the seriousness of the recession that we are absolutely convinced will happen. So I'm prepared to really stick my neck out and say markets and market commentators are wrong this round, and the economists are right. And it's interesting that economists of different persuasions are all basically agreed on the seriousness of the potential recession that we're going into. Jonathan is asking about the shorting of the market. I think I've answered that question. And then the whole question about the rand strengthening closer to its long-term average of about 14 rand to the dollar. I think that what we will see is that emerging markets, there's a three-stage event. The first stage of the event is the crisis that reduces liquidity. And it's interesting that one of the things that central bankers have done is they've created massive liquidity inside the big blocks for developed economies. So the dollars, euros, yen, even pounds, they are massive creation of money in order to assuage the liquidity problems. And we've seen that in markets. That's one of the reasons why markets haven't gone down more. But basically, they've not created anywhere close to enough liquidity outside their own blocks. So that's why all the developing economies which can't print hard currency are experiencing significant pressure. So that's the initial stage. The second stage is a stage where it becomes clear what the problems are, but there's more calm in markets and there's a calmer assessment of what happens in markets. And then you get a search for yield. So it's very unlikely that you'll get any yield at all in dollars, yen, or euros for the next 5 years. So here you have a nice prediction, 0 interest rates for 5 years in all hard currencies. Therefore, that will be very good for gold, because gold, the problem with gold normally is it doesn't yield anything. But in this case, hard currencies won't yield anything either, and at least you can't print more gold. So gold price should be supported by the low yields, but also developing currencies with some yield. So again, you'll see that in South Africa, interest rates have come down quite a bit, but there's still a much higher yield in rand than in dollars. So we think that there will be a surge for yield, and that will push currencies, developing market currencies, back, but not quite to where they were before in terms of their long-term averages. So the question is probably not 14, more likely 15 in that stage. And then you get stage 3. Stage 3 is where the infrastructure projects around the world really starts kicking in, and emerging markets start exporting lots and lots of commodities into developing countries and into developed countries and into other developing countries, because there'll be massive infrastructure projects going up around the world in order to try to inject steroids into the economy. So the analogy is the patient, initially you have an induced coma, you add glucose just to keep the patient alive. That's what's currently happening in terms of the relief packages. But then eventually you also have to, once the patient gets up again, you need to actually give it a lot of steroids to get it to start building muscle again. And at that point, we'll see the rand a lot stronger. Levels of 12 to 13 is not impossible in 2023, but that's a long time from now. So, for now, I would say a level of 15 to 16 is something that I wouldn't say is too far away. I think we'll go back to 15, 16 fairly quickly, just because of the yield pickup that we have. So as soon as the liquidity strain fades, people will go for the yield pickup, and then emerging market currencies will be a lot better. Maybe just one more comment on the South African situation. The fact that we've now announced a very significant relief package basically reinforces the idea that the South African government has not given up hope on containing the epidemic in South Africa. So what they are doing is they are digging in for the long run in terms of lockdown. So the intention of the South African government, remember, the governments are presented with two options. The one option is to support people in terms of food and income while they stay at home. The other option is to reopen the economy. And it's clear that the South African government is leaning towards the first. So we're going to stay most likely in some fairly strict form of lockdown until such time as the epidemic has passed, and that the government seriously wants to make sure that we don't get a full-on epidemic running through the South African population. My own personal opinion is they can't prevent it. It will happen, even if it has a slow start, because we already see that infections are still rising in spite of the lockdown. What you should be seeing at this stage of a lockdown, if the lockdown is being maintained fully, is that new infections should be going down significantly. So I don't think we can contain it, but it's certainly the government's intention to continue to lock down to contain it. So I think the comment of start to ration your dop is probably appropriate, because we're going to see the lockdown lasting quite a while longer in South Africa.
Thanks, Wikus. Just another comment from my side is that listening to the questions you've already had, what we have been discussing today is a fairly general situation. And we know from our long experience that everybody has an individual situation. And that's what we encourage, why we encourage an individual chat subsequent to this meeting, because there are solutions that are slightly different in each situation. And when we send you the recording of these talks, we would encourage a Microsoft Teams chat with you to get a little bit more detail on what you have got at the moment in terms of investments and strategy, and following that you will get some more in-depth advice, and that's what it's about. We are advisors. We have no ties to any particular investment asset house or bank, and you will know that you'll get some decent advice from us, if nothing else.
So I think that Lee, thanks for that. The first thing I would say is, I think that our clients have had as good an experience as you can have when you have an unprecedented disaster in the economy. So our clients, because their planning has been properly in place, and because they've had multi-asset investment strategies in place, which also contain safe assets that protected them when markets started falling, I think our clients have come through this up to this point with as good a position as is possible. What we do expect is that if markets come down a lot more, first of all, our clients will be safe because we've positioned them to be safe. But secondly, they will be in a position to utilize the unique opportunities that are likely to present themselves. On the other hand, if we are wrong and markets go back to where they were before, our clients will only miss out on some fairly modest opportunities. So we think that the risk reward is very much in favor of staying very conservative in terms of market exposure at this point. Thank you very much. I think we'll wrap that up for today.